Hey everyone, this is Mike Finnen from Buttonwood Tutors, and today I'm going to talk to you a little bit about common stock. I'm going to try to go over all the key points that you need to know for the SIE and in general. I worked on the New York Stock Exchange for 37 years, so I like to think I know a little something about how common stock trades and what common stock is. First things first, what is common stock? What is stock? Right? So issuers have to raise capital, and they have two ways of doing it. They can either take on debt, where they literally borrow from investors, or they can give a piece of their company. Just like if you owned a bakery and the bakery's worth $100,000, and you said, okay, I'll give up 25% ownership of that. That would be $25,000 that you would be giving up in ownership in stock to that bakery. In terms of like thinking it in terms of the stock market is, so say you buy Microsoft stock, you own 0.0001% of Microsoft stock. Then in that case, Bill Gates owns $200 billion worth of it. You own a couple $1,000s worth, but you're as much of a shareholder per share as he is. And at that point, that also gives you what we would say is voting rights. Okay, so you have voting rights for every share that you have. You get one voting right. What does the voting right mean? The voting right means that if you can vote on the big matters that come up, and specifically on the board of directors, and if they get vote whether they get voted in or out. It is like almost like a republic, like the democracy, right? You don't get to vote on individual everyday matters of the company, but you do get to vote on who is in the board of directors, and then the board of directors picks the executives, and then the executives run the day-to-day operation. Um, Secondly, when you have shares, it gives you a right to prorated dividends. What does that mean? For whatever percentage of the company that you own, should the company give out dividends, you get paid on the dividends. Now, what are dividends? Dividends are when a company has earnings, they have a couple different things they can do with it. If it's a growth stock, which is a newer company or a growing company, they're going to take the money and put it back into the company. If it's an older company, a more established company, a value stock or blue chip stock, they're going to take some of those earnings and put it and send that to the shareholders. So let's take, for example, let's say a growth company makes $4 a year in earnings. It's $1 a quarter. When they get those earnings, they're going to send most of that money is going to go back into the company so they can grow. Say take it's a restaurant chain that is in, say, Texas and Oklahoma, and they want to expand to the entire country. Well, they're going to use the money from earnings to expand. Okay, but now on the other hand, and that's a growth company, so they'll have a higher price earnings ratio, a little more speculative on price to earnings, market price to earnings, and a value company is going to be a lower price to earnings because they're more established, because we don't think they're going to start making 30 and 40% a year. So we're going to value them a little lower PE wise, but they don't need the money to grow with. So they're going to pay out more of a dividend. If they make $5 a year in earnings, they may pay out 490 of that. Now, if a company pays out $5, if a company makes $5 and they pay out 490, that means they have 10% retained earnings. The retained earnings are what they don't pay out to the shareholder. Let's say a growth stock has, they make $3 and they pay out nothing in dividends, then that is $3 in retained earnings. If the what hits the fan, okay, if the company goes bankrupt or there's a problem with the debt, there's a liquidation pecking order, okay, and it's over on the right. This is the liquidation pecking order. But as far as stocks go, you're at the bottom of the liquidation pecking order. In general, if a company goes bankrupt, shareholders are not going to get any of the money. So on one end, you're at the most risk for if the company goes belly up, but on the other end, if the company goes up, you get the most capital appreciation. You can grow. And don't forget, a key thing, common stocks are the best hedge against long-term inflation. Okay? In general, what we're looking at with common stock is a 5-year time horizon or more, but against short-term inflation, they're not great hedges because they can fluctuate, but against long-term inflation, common stocks are your best bet. And that's why you want to, the younger the person, the more they have to have common stock in, because they have to beat inflation. fixed income products struggle against inflation because they're fixed. They can't do anything about it. One of the other aspects we have with common stock are stock splits. These are things that people struggle with on the test, right? So a stock split is if your stock is doing too well, it's trading too high, it gets up to be $1,000 stock. All right. People don't want to buy it, which sounds strange, but it's true. And think about this. If you were offered a stock for $100, if you were offered 100 shares at $10, or one share at $1,000, which one are you going to take? You're going to take the lower one every time. The 100 shares at 10, it just feels better to have 100 shares, but it's the exact same amount of money. But what companies will do is when their share price gets too high, they will cut down that share price. They will do it by doing a stock split. So it'll be like a 4-for-1 stock split, which is a forward stock split, or a 5-for-1, or an uneven one would be a 3-for-2, or a 7-for-5. And the way you figure it out is you just divide you take the top number into the bottom number, the numerator into the denominator, and you say you get a stock split factor of 4, and then you multiply the shares and divide the price. So, for example, let's say that I owned 100 shares of XYZ at $50, and it was a 4-for-1 split, 5-for-1 split to make it easier. Okay, that means 5 divided by 1, I would get my 5 stock split factor. I'd multiply the shares. That gives me 500 shares. I divide the price. Now I'm down to $10 on the price. That $10 is a much more attractive number to a lot of shareholders, especially retail shareholders. And if it was the other way, sometimes you get what's called a reverse stock split, where a company is not doing well and the shares are so low, they're about to get thrown off the exchange or thrown off OTC. So what they do is they do a reverse stock split. So they'll do like a 1-for-5. And in that case, you'll get 1 divided by 5 is 0.2. You multiply the shares, so you wind up with less shares, you wind up with more price. So that's how stock splits work. You also have stock dividends, which are more likely with a growth company. And in that case, you're getting 25% more shares. And that is stock. So if they give you a 25% stock dividend, you go 0.1 share times 0.25, you decimalize it to 1.25, multiply the shares, divide the price, and there you are again. And also this comes now. One of the things we like to talk about on the test is that one of the things that comes up on the test is dilution. What is dilution? If you guys remember Facebook, one of the great lines was that the guy who was Mark Zuckerberg's partner, who he thought he was a 30% partner, found out from the lawyers that he'd gotten diluted down to 0.001% or whatever it was of shares. Not a good day for him. Still worth hundreds of millions, but nobody wants that to happen to them. And what happened there was that he originally had. So just to give you an idea how dilution works, let's say there's 100,000 shares outstanding. That's how many shares are in the company, and you own 10,000 shares. That means you own 10% of the company. But then let's say that the company decides to raise more money and they issue another 100,000 shares in an after public offering. Well, now there's twice as many shares outstanding, but you haven't gotten any more shares. So you just went from 10% down to 5%. Again, so originally there was 100,000 shares. You own 10,000, that was 10%. They added another 100,000. Now there's 200,000. You still only own 10,000. So now you're down to 5%. So what they do is they have called a preemptive right. The preemptive right will allow you to buy a right to the equal amount of shares that you have, or whatever. One right equals 1 share. And then they might say, okay, for every right you get 1 share, or for every 3 rights you get 1 share, or whatever it is that will keep you whole so that you don't get diluted. And also, those preemptive rights are issued at a lower price. They're free money, free money, yo, right? So if you get a preemptive right, you get, say the stock's trading at $50. They say to you, okay, you can buy another X amount of shares at $40, even though it's still trading at 50. So you have 3 options then. You can exercise the stock, so you get new stock, or you can buy or sell the right, or you can let it expire. If you're, it's so ridiculous to let a preemptive right is free money. So even if you can't afford to buy the shares, you want to at least trade the right. And these rights usually are short term, 60 to 90 days, that kind of thing. So for those 60 to 90 days, though, those rights trade as what's called a when issued. It's almost like a separate stock that takes into value between 50 and 40. Now, there is a, on the test, there is a preemptive right, there is a cum rights and X rights valuation. I'm going to tell you that, there's certain things that I talk about in this test. They say that's one of the last things you want to look at. You can look at it if you want, but you don't have to. But, if they ask you an extra cum rights question, and we're going to nod our cap until we're near the end, and then we'll try to figure out. It's not a big deal, and it's not worth the risk reward of trying to figure it out. So basically, to know what the rights are, they're short term, they have immediate intrinsic value, and you always want to exercise, trade. You don't want to let them expire. Now, the other thing is that warrants that get issued, warrants are longer term, usually issued with bonds as a sweetener. I'll hit warrants later down the line. Now, last thing I want to touch base on this particular dialogue about common stocks is the liquidation priority. You've got to know the liquidation priority order for the SIE and for all the FINRA tests, really. Okay. So what does this mean? This means if the company goes belly up, if the company goes bankrupt, okay, then what is the liquidation priority? All right. First, secured creditors, bondholders, debt holders that have collateral. They get paid first before anybody when things are going bad. Okay. Next line, we go to unsecured creditors, which are basically debentures, long-term corporate unsecured debt, and with that, general creditors also. Um, Below unsecured creditors, you're also the next one. These are considered senior debt holders. We also have junior debt holders or subordinated debt. And now, then we go to preferred shareholders, which is another form of equity we're going to talk about. Preferred shareholders. Right now, we're talking about common stock. Preferred stock we'll hit on in a different video. Preferred stock are also equity, but they act much more like a fixed income. But the most important thing is they're above common stock on the liquidity wheel. And lastly, common shares. Okay, so as a company's going out of business and they work their way down of what's left and what's not, we go collateralized debt. They go first. Plus, and collateral means that if they had anything up against it, they get to liquidate that. Unsecured are the basic, full faith and credit bonds. The junior bonds are full faith and credit junior bonds. Then we have the preferred shareholders, which are equity, but they act more like fixed income. And lastly, common shareholders. So basically, common shareholders, what they're getting is capital appreciation, buy low, sell high. They can get the most out of. They have the most upside. But if things go bad, they're most likely to walk away with nothing. And that is how the common shareholders go. So again, if you owned Amazon and you own point oh, you own 100 shares, you own 0.001%. One quick side story. So back in the day at the exchange, early 90s, probably into mid 90s, one of the people who worked for one of the firms that I had that I did business with, and I did all institutional equity. I never did retail. Jeff Bezos. Okay, Jeff Bezos was an analyst slash trader at one of the funds that we did business with, and in the mid '90s, we had heard, Wall Street rumors. Everybody's joking. Everybody's got something to say about everybody. The story started going around that Jeff Bezos went and started a new business in his garage. He left Wall Street. This is like the peak of Wall Street, '90s, right? So he left hit the business and started a new business in his garage, that he was going to sell books on the internet. And everybody's like, oh my God, what a maroon, leaving Wall Street, giving up a sweet job at a great fund, this just to go and do some ridiculous, ridiculous internet book company. Well, guess what? Guess who got the last laugh on that? As he just had his $50 million wedding with his newfound wife in Italy. So never judge a book by a cover. You never know what's coming in life. So that is the 10,000 foot view of common stock. hopefully that helped you out a little bit. Again, this is Buttonwood Tutors. If you're taking any of these tests, feel free to hit me up. I do private tutoring. I do a little bit of group tutoring also, and I wish you all luck on your tests. Thank you.